Hi everyone, good evening. Thanks for sparing your precious evening time to be here with us. My name is Yuling and I am the investment lead at Endowus. With me today is our guest of honor, Apollo Lupesco from Dimensional Fund Advisors. So for today's webinar, the main purpose is really to hopefully give you a compass to help you navigate through today's market and to give you some idea in terms of how to enhance the odds of your investing success. We know that markets have been volatile and it has been defying a lot of investors' expectations. So you must have a lot of questions in terms of, where the valuation is at today. Should I be shifting from cash to fixed income, etc.? Don't worry about it. We will try to address all of your questions and we will try to make the session interactive as well. So please make sure to go to the Slido link that I will share later to leave your questions there. But now, welcome again, Apollo. I know it's not a short journey from the US to Singapore, so I'm very excited and very grateful to have you here with us tonight for a whole hour. Would you like to give a quick introduction of yourself to the audience? And I have a fun question for you just to kickstart the conversation a little bit. Can you share with us what is your favorite Asian food?
Okay, love it. Well, first of all, thank you so much for the invitation to be part of this this webinar, and thanks to everyone for attending it. And let me start with a little background about myself. I started looking at investing when I went to undergrad in Michigan, and then one of my friend's dad ended up coming over, and he was a very flashy guy. He had a lot of things going for him, and I wanted to know, what do you do? Because I want to be like you.
Yeah.
Well, it turns out that he said, well, I pick stocks. I'm a stock jockey. I invest in the market, and I do pretty well. And that kind of piqued my curiosity. Well, what is this whole stock market thing? It seems like I want to be like him. I want to make the money and have the lifestyle. And I started to take classes, and I went to finish my undergraduate studies at Michigan State, and then eventually got a master's in economics and finance, and then a PhD at the University of California in Santa Barbara. And after that, I ended up just finding Dimensional, because Dimensional happens to be this institution that manages money based on very rigorous academic research. And as I was teaching classes, a lot of the papers that I used to teach and I studied were written by professors who were associated with Dimensional. And I was so enthralled by the idea. Here's some Nobel-winning scientists who are associated with this firm, and I really like the data and the evidence. So I joined Dimensional 20 years ago, and here I am in Singapore.
That's great.
Back in Asia. And just my favorite, I think it's dim sum. I really like it. I love it, and particularly if it's good.
Yeah.
I just came back from Hong Kong, and I came from Hong Kong, and it was actually some really good dim sum there.
That's great. I love dim sum too, but I agree the Hong Kong dim sum is.
It was actually quite special.
Really.
I haven't tasted much here yet, but
you should try some local food.
Oh, I would. As soon as we're done here, actually, that's exactly where I'm going.
Great. Okay, so we will have a longer conversation with you, more heavy subject investments, but you are the expert in that. Before that, I do have some housekeeping items. So I need to show the disclaimers for both Singapore investors and Hong Kong investors, and just some general risk warnings. And a very important link here for you, and that's the Slido link, for you to really go there and put your burning questions. We will try to address it throughout the session, but we also have a dedicated section at the end to go through the live questions. And now, a quick introduction of Endowus. So, empowering everyone to invest better and to live better is a mission that is at the core of Endowus, and that drives every single thing that we do. We are a digital wealth platform that seeks to resolve the major pain points in everyone's wealth journey. And at Endowus, we provide conflict-free financial advice, access to institutional-grade products, all at low and fair fees. We work with over 80 fund managers globally in the public and private space. And our investment office, me myself being one of the members, conduct in-depth due diligence in the entire fund universe to offer the best curated list for our clients. And on top of that, we also offer advisory heavy customized portfolios that is tailored to each individual's risks and preferences. So at Endowus, I assure you will have a new wealth experience. For example, if you are in Singapore, you can consolidate all your investments across cash, SRS, and CPF on a single digital platform while enjoying great financial advisory services. If you are in Hong Kong, please check us out as well. I am sure that the fee amount saved, as well as the product availability that you will gain, is incomparable. We are backed by global strategic and venture shareholders, such as UBS and Citi Ventures, and we are well recognized with industry awards and accolades. So now, Apollo, I know Dimensional very well, and it is very famous in the systematic investing space. Yet in this region, it's still little known to people on the streets, just everyday investors. Would you like to give us the introduction of who Dimensional is and how you work with advisory firms like us?
Yeah, so Dimensional, you're absolutely right. It is not a household name. And in fact, it's not just in Singapore, but even in the United States. We are in the top 10 largest investment managers in the country and in the US. And we manage roughly about 720 billion dollars in US dollars. So $720 billion in US dollars. So a relatively large firm. It's not peanuts. And yet people don't know us because part of the business model that we have adopted from day one was to really work with institutional investors. And our clients for the first 10 years were only large pension funds, were only endowments and sovereign funds. And for the past 25, 30 years, we've actually started to work with a very select group of financial advisors and treat them almost like the consultants for the large pension plans and really look at these advisors as being almost like a coach for a consultant for families and individuals. But in that respect, because we don't distribute the funds to retail investors, there is no need to have billboards. There's no need to put anything in the paper and say buy Dimensional, because a lot of times the Dimensional funds in the US cannot be purchased by individual investors. There has to be a consultant, a financial advisor. And because of that, we're not a household name. What's interesting about Dimensional is that what sets us apart, I think, beyond the business model, is that as I mentioned, I think we're the most successful cross-fertilization between the academic community and the rigorous scientific research and the practical world of investing. Over the years, we've been associated with 5 different Nobel winners in economics. And these are folks who work very closely with us, not somebody we pay to put their name and associate their name with us. No, from day one, they've been associated with Dimensional. And our goal was to build this investment platform around the rigorous scientific processes. And what that led to is a very distinct way of investing money. Because as you know, and it's been obvious to me as I went into Hong Kong, a lot of people still believe that buying an individual stock and or trying to figure out when to be in and out of the market is the definition of a successful investment experience.
Like what you believed when you met your father's friend.
Exactly right. That's what I thought. And by the way, it turns out that the guy ended up divorced and lost everything. So it wasn't a happy story.
Okay.
But what's interesting is that over the years, what we found is that whatever might have made sense 30, 40 years ago, it is no longer state of the art today. Yeah. So at some point, the founders of Dimensional were the first to take these academic ideas and create the very first index funds. Yeah. So when you think of index funds and Vanguard or BlackRock and all these companies, well, it turns out that the founders of Dimensionals, before Vanguard had an index fund, before BlackRock, they actually created those. And there was a realization there are inefficiencies around index funds. So that's what Dimensional was created to move beyond indexing and create a strategy that is designed to outperform, but not through picking stocks. And I think that's pretty unique to have a strategy that's neither stock picking nor indexing. And that's very unique in the whole world. Very few firms, if any, are really doing this successfully.
Yeah, I think we need your help to wrap our heads around it because it's a very new concept to a lot of people.
Right.
So actually, my next question is right towards that.
Yeah.
It's more philosophical.
Yeah.
And that is, many investors, they believe that investing is more of an art than science.
Mm-hmm.
So how would you say to that?
I think that investing has multiple factors, and I think you can call it whatever. And there's not a right or wrong way to say it. But what I think investing has to do ultimately is pragmatism. You have to be very pragmatic. So when you make a decision to invest or not invest, in my opinion, it cannot be based on a hunch. It cannot be based on a belief. It has to be based on some numerical data. The whole world is moving that way. Like if you how business managers are making decisions, they're not based on how they feel. What does the data suggest? And in that respect, we're very big believers in a data and evidence approach to investing. And the art, if you want to call it that, so that's the scientific part, the data part is absolutely that. But there's absolutely an art to the way that you take these ideas and you implement them in the real world. And the analogy that comes to mind is if you fly a plane, for example, there is a computer. And the computer is very helpful. That's the data part, if you want to call it that way. And an index fund, for example, is just simply letting the plane fly by its own on the computer. What we think is that that's good to have the computer, but it's also good to have a pilot in the cockpit. And I think that's where the art comes in. There are situations we need to navigate, and you can't just let the computer do on its own. So I think that it doesn't have to be one or the other. And what we're trying to do is blend the two. As being an art and a science.
Yeah. So can you elaborate a bit more? What do you mean by dimensional being grounded in academic research and empirical evidence?
Yeah.
And do you believe in inherent trends and patterns in the market?
Yeah. So the way I think about it is that there has been an evolution in the way investing in the U.S. and pretty much around the world has emerged. And if I were to kind of draw a little sketch that might be helpful, there was a moment in time where successful investing was about looking at different stocks. And let's just say this box is the entire stock market, and let's analyze individual companies or trends and really see what we like out there, and cherry pick a handful of stocks that would be the best ideas and they would make the most sense, and leave out everything else.
Sure.
And I would say that system was pioneered by a gentleman named Benjamin Graham.
Yeah.
And you're familiar with Benjamin Graham because he was Warren Buffett's mentor. And certainly Warren Buffett credits Graham for his success because he taught him to look at numbers, not to just make it at the art, but also look at numbers. And I would argue that when Benjamin Graham developed these ideas back in the 1930s, there was a legitimate way in which you can analyze a company and then ultimately find, well, that's a stock that's undervalued, overvalued, and whatever you decided to. The thing is that over time, that system that is based on information and having a competitive edge because of information has changed. So think about information. Back about 50 years ago, perhaps there's a way that you can get information faster than others. If you had a faster fax machine, you got it faster. Perhaps you can get better information than others because you have access to that, legally or not. That's debatable. Sure. But also because the majority of trades were done by individuals. And if you're a sophisticated investor, then you can cherry pick some, you can pick some pockets and take their money from the retail investors. Today, everything's changed. I mean, how long do you think it takes for information to travel to investors? It's almost instantaneous.
Yeah, and the composition changed too.
Absolutely. Yeah. Today, just to get an idea, in the US, there are more professionally managed funds than actual stocks trading on the market. Sure. So the competition is incredible. And everybody has access to all kinds of information. So which begs the question, ultimately, like if you're going to do this, what are the chances that you can consistently outsmart everybody that you're dealing with? And the data and the evidence, what's suggesting right now is that, we have studies on this, that when you look at these funds who are trying to actually do exactly this old school way of thinking, over a period of time, let's say 10 years, about a third of them disappear. They don't even exist anymore. And then out of the ones that exist, only about 1 in 4, so 27% outperform. In other words, you talked about odds, and I love that you said odds. If you are an investor trying to find this manager picking stock in this day and age, not 50 years ago, you're much more likely to identify an underperforming fund than a high performing. And in fact, if you go to 15 years, it gets even worse. More funds disappear, survivor meaning that half don't even make it, and out of the ones that survive, 1 in 5 outperforms, and over 20 years it becomes more like 1 in 6 or so. So what I'm suggesting here is that the odds of finding a manager who can pick stocks is very low. So that might have made sense 50 years ago, 100 years ago. Today, based on how information travels, it's hard to believe. And by the way, I mean, I'm inviting all of you on the call to think about this. When you are placing a trade and you have a belief that one stock is better or worse than the other, you are likely on the other side of a trade when there's an army of MBAs and PhDs from Stanford and Harvard and MIT and you name it, and they have a different view than yours.
Of course.
So it's so competitive today that's why you're seeing these results. These results are just reflective of how competitive and the fact that you have to charge fees, and a lot of these fees are high. So what in fact, what the system that the academics and dimensional pioneered was a different type of research. And in that particular type of research, what we are interested in is not necessarily any one particular stock, but rather what we're interested in is really those stocks as part of a larger group, a larger basket of stocks. So if you're gonna you kind of again visualize this, it's perfectly fine to own these great ideas, these stocks that somebody thought of. The trouble is, because information is so competitive, it kind of reflects what the consensus is on the valuations. So rather than research individual companies, what Dimensional and the academics have done, because of the computing power, because of the databases, is analyze much larger baskets of stocks, much larger groups of stocks. So investing, in my opinion, today, is no longer about researching individual stocks, but getting a sense of much broader groups of stocks. Something that's become known as asset class investing. And I'll tell you in a second. I was trying to explain this to my mother-in-law, and I hope one day I should watch this. And the way that I kind of try to reflect on it is I went swimming in Florida, and it was warm water, put my goggles on, and at some point there was a really pretty school of fish swimming underneath me. And you look down, and every fish was moving so randomly, up, down, left, right, sideways. No way can predict how each individual fish moves. On the other hand, once I swim a little bit longer, you start to capture and understand the behavior of the entire school of fish with a lot more precision. So we're not trying to fish by the rod, which might be fun, but not productive. We're fishing by the net. And we're trying to understand the behavior of large baskets of stocks. And that's the first big lesson for investors. Instead of looking at individual stocks, own those stocks as part of a larger group. And then I'm going to dwell for one more second. The challenge for the academics has been, how do you differentiate?
How do you find the particular group of stocks that will outperform consistently?
And that's the key. So the first thing that I'll have to say is that initially investors and academics thought about sectors, pharmaceutical, transportation, industrials, whatever. It turns out that there is no good economic story, no good economic model to justify why one should get paid more than others. And that's not really robust. But rather, what the academics have found out is that there are other economic determinants, and one of them is, for example, the size of the company. And I'm going to use two companies to illustrate. McDonald's. Everybody knows McDonald's. And
people here love McDonald's.
And I love it too. In fact, I mean, my daughter and I just always go there. But McDonald's is the illustration of a large, well-established, mature company. It's been around for a long time. It's got a track record, a lot of things going for it. And that to me, let's make them the poster child of large companies. You can invest in McDonald's, that's great. There's also another burger chain right here in Singapore and Hong Kong called Shake Shack. I also like Shake Shack. They're both very good burgers and fries and shakes, pretty much selling the same thing. I mean, not vastly different. They're good, both good. The thing is that if you think of Shake Shack as the illustration of small companies and you compare with McDonald's, between these two, which one has, perhaps an easier time growing and doubling in size? The smaller ones, likely it's going to be easier for Shake Shack to double than to McDonald's.
Yeah.
On the other hand, the fact that you have that track record, the fact that you have the mature company warrants perhaps a lower cost of capital.
Yeah,
like if you're a better risk as an investor, you pay a lower interest rate. And in that respect, what we found and what academics found, and this is Dimensional's also research, is that the smaller companies, they tend to have a higher expected return than the larger ones. So if an investor, you want to you want to achieve higher potential results, one of the ways is not just buy the S&P, but also look at the 2,000 companies that are part of the U.S. market in the small group of stocks. And some of them are going to fly high. Some of them might even go away. But as a group, historically, small company has done better than large. There's another category which has to do with valuations. You mentioned valuations.
And that has to do with Benjamin Graham.
Absolutely. You absolutely got it. Value investing. So what exactly does value investing mean? What it means, and just to make it in real terms, in Singapore, in Hong Kong, all over the world, if you have two apartments, two houses on the same block, and one sells for $300 a square foot, the other one for $800 a square foot, when you can measure on a relative basis and you have a unit of measurement per square foot, what you typically find as an investor into, let's say, real estate, is that buying the lower cost tends to perhaps give you an easier time to flip and make money. It's, on an intuitive level, it's the same in the market. You can look at valuations, meaning how much does it cost me as an investor to buy $1 of assets from a company after liabilities are paid, which is called book value. And you can compare apples to apples. For one company, it might be 2, for the other one, it might be 10. You can look at intuitively at earnings. If I want to buy $1 of earnings from Google, how different is that if I bought it from NVIDIA? And what research has shown is that the companies that have a lower price, and those are called value stocks, historically have delivered better results than the more expensive counterparts called growth. So that has given investors a primer, saying, okay, look across the entire market, buy the entire school of fish. But the more you're willing to emphasize small companies, the more you're willing to emphasize value stocks, you give yourself a chance to earn a higher payout. And that's absolutely shown in the data in the US and around the world.
Of course. Now, that's a really great segue to my next question, which is just on S&P 500.
Yes.
It has gone very high.
Yes.
It was up 26% last year, and I think up more than 4% this year so far. So I think it's a conundrum now, right? Investors are both worried about its high valuation, while at the same time fearing that they will miss out on further potential gains. So how would Dimensional say to this, and what principles should investors bear in mind?
And so I'm so glad you brought it up, because you're absolutely spot on. In fact, it was 26.3%. That was the return in the U.S. stock market, the S&P 500 last year. And what's interesting is that this 26.3 is one number that is reflective of the individual performance of roughly 500 different stocks. And not every stock went up, not every stock went down. And that's a really good place to start, because quite often you see that one number. Well, what that number reflects is just some companies actually made money and had positive returns, and some companies lost money. And on a year to year, it's pretty random. But here's what's interesting. The way that we arrive at this number is by looking at the size of the company, and size here meaning how many shares of ownership does a company have, multiplied by the price of each share. And you get a sense of the overall ownership value. And the larger the ownership value into a company, what's called market capitalization, the greater the emphasis on that particular stock. So not all stocks in the S&P are treated equally to arrive at this 26%. And in fact, if you're going to look at the S&P as a whole, right now, the largest stocks in the market have actually gotten a nickname. They're called the Magnificent Seven, and you're probably familiar with those. And they're Apple, Microsoft, Google, Amazon, Nvidia, Facebook, and Tesla. And the reason they got the nickname, Yelena, which I think is so interesting, is because if you look at these 7 companies on the side and you take them aside, last year they had a remarkable year. On average, between the 7 of them, they went up by 105%. That's an outstanding growth. And that's what people really took notice, particularly because they left a hole in the S&P.
Yeah.
And if you look at the remaining 493 stocks in the S&P, they were up, but also by a much more modest 14.9. So what's incredible is that last year, the S&P 500 had a really good performance, 26%. Yet it went from about 15 to over 26, driven by 7 stocks.
Yeah.
And by the way, these are giants among giants. These are not rinky-dinky companies. They're really big companies. And the reason for that is that when you add up their weight, their percentage in the S&P, these 7 stocks make up about 28% of the entire value of the S&P, which is very concentrated in my opinion. And yet, the same exact 7 stocks are also part of another market metric called NASDAQ. And in the NASDAQ Composite Index, the same stocks represent almost half of NASDAQ comes from 7 stocks. It's incredibly concentrated. And if you go the other way, and you also look, for example, at the small companies, you look at the S&P, but in the market in the US also having the small ones, the same 7 stocks amount to about 24%.
Yeah.
And in a global perspective, if you were to have a global perspective, which a lot of investors have these days, the same 7 stocks amount to only 15%. And the reason I bring this up is that what we find is that when you measure market performance, there could be great discrepancies from year to year. Not because anything goes wrong, it's just how do you measure and what do you measure? In a year when these Magnificent 7 are flying so high, well, NASDAQ is going to look phenomenal because it's so concentrated in it. And in fact, the S&P was up 26%. Last year, NASDAQ was up a whopping 44%, more so than the S&P. And that's when a lot of people said, well, we want to own more tech stocks because they did so well. Our view is that you have to take a step back. And the first big lesson of investing is not necessarily to concentrate into a handful of stocks. Because as well as the NASDAQ did in 2023, if you take a single step back, 2022, NASDAQ was down about 32%. In other words, when you concentrate, you have a wide range of outcomes. You can either make a lot of money or you can lose a lot of money. And we think that successful investing is about avoiding extreme outcomes. And to kind of lead into what we believe that investors should own these companies. You don't want to miss out on them in a more diversified way. So if instead of 49%, you own them at 15% in a global allocation, well, the first clear benefit is that you are avoiding extreme outcomes. You will be disappointed last year because you didn't do 44%. But on the other hand, you're also going to be very happy that it didn't drop as much as it did the year before. And when you look between these 2 years, not only that you have avoided these extreme outcomes, but performance-wise, you would have done better. NASDAQ between these 2 years is still down. This global portfolio is up. So the 2 big lessons that we believe in, number one, we believe in global diversification. We believe that you ought to own as many stocks around the world as possible and not concentrate in any one stock, any one investment. And number 2 is that you need to be disciplined and not chase what did just well. So if you're disappointed that your global portfolio didn't do the 44%, all you have to do is take a step back. And I think a lot of investors miss that. People without an advisor like Endowus, it's really hard for them to stay in their seat. So those are the 2 things that we believe, among others, is just don't have that behavioral controlling your decisions.
I guess our tendency is always to go into the best performing market, right?
Exactly.
But actually what you said resolves the conundrum in that you still own the stock S&P 500, so you're not missing out. But if you're concerned about its high valuation, that owning a globally diversified portfolio will mitigate the danger, the risk of high valuation.
Exactly right. Because if you look at these Magnificent Seven, last year they're up 105%. So you further concentrate.
Yeah.
And the thing is, the year before, the same exact stocks were down about 45%.
Exactly.
And the reason that I strongly discourage people from extreme outcomes is because it's a simplistic way to say, well, I'll take the 45% down if it's going to go up 100%.
Yeah.
But let's do some basic arithmetic. If you start 2022 with $100, and just to simplify, instead of losing 45%, you lose about 50% of your money. Well, by the end of 2022, you only have $50 in your account. And now if you start 2023 with $50 and you want to go back simply to where you started at $100, going up by 50% is not sufficient. You need to go up 100%. So when you see these big numbers, oh, look how great these stocks are. When you dig yourself in a deep hole, it takes a while to crawl your way back up.
Yeah.
And that's why we're big fans of diversification. And the poster child of this example, by the way, is Tesla. If you look at Tesla, last year it doubled in value, more than 100%. But because in 2022 it did so poorly, this is what the outcome would be for an investor. If on January 1st, 2022, you had $100 in your account invested into Tesla, by December 31st of 2023, that $100 would now be worth 70.
Yeah.
So even after the amazing rebound, you're still on the water about 30% or so.
Yeah.
And that's why we're such big fans of diversifying and not concentrating, because it can work out. It can also backfire. And that to me is, can I tell you one other story?
Sure.
Very quickly.
Yeah, okay, go ahead.
Well, it's this idea of trying to make a lot of money quickly. And I had a friend of mine who basically said, I want to make a lot of money quickly, and then I'm going to get out of the market and live happily ever after. And the thing is that this gentleman had about, I'll be honest, I mean, I'll tell the numbers. You don't know his name, but he had about 5 million.
Okay.
So that was his number. It was $5 million in his account. And he said, I want to get to about 8 million. And when I get to 8 million, I'm going to cash out. And then I'm going to be out of the game and live, as I said, I'm going to be very sick.
Yeah.
And the thing is that he kept visualizing that. And my first question to him was, okay, if you have 8 million instead of 5, how would your life be different? Would you buy something vastly different than you did before? And the reality is probably not.
Yeah.
The question is, what if it goes against you? What if instead of 5 million adding 3, what if you subtract 3 million and now you have 2 million? Would your life be different then? And I think too many of us are kind of looking and saying on the upside how much money I can make, and that fear of missing out should perhaps be considering also the fear of losing your shirt.
That's true.
Anyway, so that was the idea of like extreme outcomes.
You need to consider both sides.
You need to consider both sides.
Yeah. Okay, I have another question, which is another common concern now in the market, and that is geopolitical risk. Elections coming up. There is increased uncertainties as well as tensions between countries. People are worried about wars.
Yes.
So, yeah, with this backdrop, what strategies would you recommend for investors to navigate these macro events?
Yeah, and I think it's actually quite relevant because, having been in Hong Kong, there is a lot of concern that if China were to attack Taiwan, and then Hong Kong gets lumped together and you can't get your capital out, there are restrictions, sanctions, and so forth, that's going to have a devastating impact on people's lives. And in my opinion, that is an absolute, valid concern. And I'm not a political scientist to tell you what the odds of China invading. I have no idea. But I can say that legitimately that concern would lead to an economic downturn. So when you think about your paycheck, when you think about running a business, the value of your property, a lot of these things are probably going to take a big hit for local folks, let's say in Hong Kong. What's interesting to me is that when we look at the same issue through the prism of an investor, I think that's a little bit of a different question, because investing means that you are buying ownership in companies. That's what investing basically means. And if you are an investor, what we recommend to folks is not to limit themselves to any one country, but rather to explore opportunities around the world. And in fact, if you look and create a world map, and instead of landmass, you plot the value of all companies that can be bought and sold around the world, what's really fascinating is that you see the US is by far the largest stock market. There are about 3,600 different companies in which you can buy ownership. And they amount to about 59% of the value of all companies around the world. And what's even more interesting is that you look at Hong Kong, for example, and it's a vibrant economy, but when it comes to investing for investors, it only represents 1% of the value of all companies around the world. It's not an incredibly significant part of the world. And then you have China, which is right there at 4%, even though economically such a big country, because so many of their firms are controlled by the government, not available to investors, from an investable universe is only about 4%. So the first thing that we recommend to investors, particularly in anything related to the potential risk there, is not to put too much money into their own local market, even though it might feel good to. Well, I know Tencent and I use that bank, so let me put money there. But rather, what we advise investors is to have a globally diversified portfolio where the percent that you put in different stock markets is commensurate with the value of companies that you can buy and sell. And in that respect, the largest chunk would go to the US.
Okay, but US presidential election, what's going to happen? US is a pretty popular market for a lot of investors here.
Yeah.
Of course, people still have home buyers and all this, but people are worried.
Absolutely, and that's one huge concern in the US, by the way. It's the same as what's going to happen in the election. So let me spend a few minutes on the election because it's such an interesting topic. And if you were to look at the data, because we look at data, let's start with this idea: being an election year, does it mean that it adds additional uncertainty to investors? And does it mean that this is bad for anybody who wants to put money in the market? And in the US, we have good data going back about 100 years. So what we did is, we went back all the way to the 1920s. And in this time frame, we have had about 24 different presidential elections. And the stock market in the US doesn't go up every year, doesn't go down. The rough split is about 1 in 4 years, 25% goes up, 1 in 4 goes down, 3 in 4 goes up. That's 25% down, 75, roughly speaking. Now, within these 24 different elections, every one of them being an important election, it turns out that 20 out of the 24 years, the market went up in an election year, and 4 years it went down. So in that respect, if you're concerned about the election adding additional uncertainty and perhaps kind of making the market drop, it turns out that the vast majority of the election years, the market goes up. It's not really like something that screams concern. But if you look at the 4 years when the market dropped, well, the first year, 1932, and we had an election, but you know what else we had in 1932?
Was it Great Depression?
The Great Depression. So what might have mattered more for the market, the Great Depression or the election? Now, 8 years later, once again, we had a negative year in 1940, but that was right after Germany invaded Poland and became more or less World War II was right there on the horizon. And then you fast forward 60 years, and there was Bush versus Gore, this uncertainty with the Supreme Court and all that. But that was the year when the tech boom went bust. And that's when you had Pets.com and all the other stocks crashing. So you can say it was the election of the dot-com bust. And the last one was in 2008 with the GFC. So when you look at the data, it seems that even in the years when the market dropped during the election, there was something a lot bigger going on in the world than the election itself. Now, certainly nobody can tell you what's going to happen this year in the market. It just, what I'm suggesting is that when you look at the data, there doesn't seem to be a great deal of concern about the election itself when you look at the data. But also it's about presidents, right? And what if you look at presidents and glean something from that? And I'm born in 69. I mean, I'm 54, about to be 55. And I wanted to see in my lifetime, how did the market do during different presidents? And it was quite interesting because when I was born, President Nixon was in office. And, the long-term average for my lifetime in the U.S. market, the S&P, is about 10%. It turns out, and on average per year during the Nixon years, the market dropped by about 2.9%. And then you had President Jerry Ford come along, and the market skyrockets on average for 3.5 years or so, over 20%. And then if you fast forward to President Carter, 11%. Fast forward to President Reagan, 15.8. You look at President George H.W. Bush, 13.9. You look at President Clinton, 17.6. Great returns. And then here comes President George W. Bush. And he was very friendly to the market because he cut taxes, he long-term capital gains, a lot of things that were good for the market. And yet, on average, during the 8 years that President George W. Bush was in office, the market dropped on average by 4% per year, followed by President Obama, 16% per year, and then President Trump at about 15.2 and a one-term president. The thing is that when you look at this data, is it obvious that having a Republican or a Democrat is better or worse for the markets? Not at all. In fact, I would say that if you look at President Reagan, who was so business friendly, cut taxes, and you look at President Obama, vastly different agenda that's built around social programs, they're virtually identical. So to me, it kind of really should put some perspective. Whenever it comes to politics, it's so much about emotions. Sure. Because it touches our deeply held beliefs, our core identity, and you have to be so careful as an investor not to make emotional decisions. Look at the data, look at the numbers. Somebody tell me that one president or another, one set of policies, one party or another is better or worse for the market. We don't see that in the data at all. So because of that, we caution people not to make moves with their money because of politics and elections.
Yeah, that's really interesting data, and it's my first time seeing such detailed data around elections. Very, very interesting.
I mean, if you want to see the one that really blows my mind is in 2021, there was a special election in the state of Georgia.
Okay.
The Democrats won both races, and at that point, they controlled the White House, the Senate, and the House. Yeah. And at that point, it just became to me a natural experiment. What if you look at data when one party controls everything, not just splitting hair, then you have the presidency, but not the Congress. Yeah. They control everything. Okay. And then compare with the results of the market when the other party controls it. So when we did that, it turns out that the Republicans controlled the White House, the Senate, and the House at the same time for 13 years in this time that we have data in the market. And during those 13 years, a simple average of these 13 years shows that the market went up by 14.52%. The Democrats also had the control at the same time, but not for 13 years, but rather 34 years. And this is where I have to be very careful because in the States, when you show these numbers, somebody might say, well, you're trying to impress me, trying to pull for one party or another. No, I'm just here to look at the numbers to kind of way answer the question, which party might be better for the market or another when they control everything. Yeah. And because of that, we triple check the data and all that. And it turns out that if you look at these 34 years of the Democratic unified government control, the market went up by 14.52%.
Oh, okay.
It is identical to the second decimal.
That's crazy.
And to me, it's like when people are talking about the markets and elections, it's so much about emotions rather than the data. And politics certainly matters. It's one of the many variables. When you bake cookies, you put flour and sugar and eggs and whatever you put, and then when you bake the cookie and you open it up, you can't look and say, aha, I can see the egg yolk in there. No, it's baked in with so many other ingredients that to me is what it is. It's too many variables, but this is not a primary, not one that, it's not the garlic in the cookie. It's more like the egg yolk in the cookie.
So we've talked a lot about equities market.
Yeah.
We have questions on cash versus fixed income versus equities, and how should investors think about allocation between these asset classes. So at Endowus, we have been seeing a lot of people piling up their cash in money market funds, and now there's more interest going into fixed income or even equities. So what's your view on that?
We really believe that for many people, bonds should be part of their portfolio. And what are bonds? So stocks are about equity ownership, meaning you have a ownership in a company and you're entitled to part of the earnings that the company has. That's what ownership means. Bonds are about lending your money. And you're lending your money to corporations, to the governments who wants to borrow money. And when you do it, there's a contract. And in that contract, there is a specified interest rate that you will make on your money. And then there's also for how long before you get your money back.
Yeah.
Those are primary characteristics. And you can deal with corporations that have a better credit outlook or not.
Yeah.
But let's just say you deal with the US government, which is the most reputable borrower in the world. Well, here's one quick thing that I want to educate on. I think it's so important for investors to understand. Historically, there has been this relationship between what's called the maturity of the bond, which is the length of the contract, and the interest rate that you get as an investor, which is also called yield.
Yeah.
And if you deal with the US government and you give them the money for, let's say, 30 days, historically, you've gotten a certain interest rate that was pretty low. Maybe a couple of years ago it was 0 or 1%, whatever it was. But if you're willing to give the government your money for a little bit longer, well, let's say 1 year, at that point, investors said, well, my money's locked up for longer. I do expect a bit of the higher interest rate, which is natural. You could expect that. And in fact, if you go to 5 years, the history of bond markets show that it's even a bit of a higher interest rate at that point, higher yield. And you really go to longer, 10 to 20 years, it's even higher. And if you draw a line through all these points, what you get is something called the yield curve. And that's the connection, the relationship between how long is your money locked up versus the interest rate. And this is what's called the normal yield curve, because normal means that it's kind of the nature of things. That's how normally bonds have operated. Over the past year or two, what's been so interesting is that the very short term, let's say 30 days, 60 days, they have jumped like to 5.5%. So very high from being very low, which is really interesting. But the other interesting fact is not only that they jump so much, but we have seen a bit of an unusual situation, not unprecedented, but unusual, where if you lend your money now for 1 year instead of 30 days, you're actually going to make a little bit less interest on your money. In fact, if you go to 5 years and 10 years, you're going to make less. And it's still a yield curve at that point because it connects the maturity with the interest rate. But this yield curve is called inverted yield curve. And inverted meaning that it's a bit of an anomaly, not unprecedented, but unusual. And why am I saying that? These days, some of these investment products like CDs, I'm not sure what they're called in the certificate deposits in Hong Kong and Singapore, they might have a different name. Fixed deposit. By their nature, they're obligated to buy in this very short-term range, which today pays you the most. And that's why you're seeing advertisements. The trouble is that what they're doing is they are buying bonds that in 30 to 60 days will mature. The question is when those bonds mature and they need to reinvest, and which rate will they reinvest? Will this 5% stay for a long time? And I think a lot of investors are doubting. So enjoy it now. And if you have short-term needs, absolutely take advantage of this if you have a plan that requires to have short-term needs. Most plans that we see also have some intermediate needs that's not over the next 6 months or a year. And if you have a need that's, let's say, 1 to 5 years, I think bonds still make a lot of sense. And if you have a 5-year and or beyond horizon, it absolutely also makes sense to consider the stock market. So in my opinion, I think that there is this notion that I can de-risk. I can take the money off the table. Why do I need to invest in the market, in the stock market or bonds, when I can make 5.5% on my CDs? It's a very short-term solution, folks. Enjoy it while it lasts, because it's unlikely, in my opinion, for that to continue. A lot of it, in my personal view, has been driven by inflation. And as inflation comes down, I have serious doubts that this is going to be the case for the long run.
I think the market consensus is that the rate is going to come down at a certain point. We don't know when, and the expectation has been getting delayed and delayed. But you're right, at a certain point, this is going to go away. And at that time, it will be too late to lock in the longer term.
Exactly right. And a bond fund, at least let's say a bond fund that has a mandate of 1 year. The bond fund can absolutely go and buy these 30 to 60 days. But when we go back to the normal interest rate curve, well, they also have the option to go to 1 year, whereas the money markets never has that option. I mean, remember for 15, 20 years, how many people were saying, let's go buy CDs? Nobody wanted to buy CDs because that was the lowest rate. So why would anybody want to buy? But right now, again, enjoy while it lasts. Not sure when. Everything that you do, whether you buy stocks, bonds, or CDs or deposit, it should be based on a plan, not on a whim. Have a plan. The most important thing in investing, identify why are you investing, what do you need the money for, how much money do you need, and what is your risk capacity? What is it that you can invest and still sleep at night?
Yeah, great. So Apollo, thanks so much for sharing all these insights. We are running a bit tight on time of 10 minutes, and we have a lot of questions. Yeah.
Flies by.
It's really great that we have received so many questions. So I think a lot of them we have actually addressed. There's a few questions on valuation, a few questions on fixed income. Let me just ask you a first question.
Yep.
Quick fire, okay?
Yep.
We can get through as much as possible. Someone asking, why should one go with dimensional funds when index funds are beating dimensional funds and dimensional fees are higher? Is your fees worth it?
Yeah. The answer is absolutely. I'm so glad you asked that. First of all, let's talk about the fees. When you look at fees for mutual funds or investment funds, they range from incredibly rock bottom to high fees. Where dimensional ranks is very, very close to index funds. But our goal is not to be the cheapest investment fund. Our goal is to be the best value. So if you have to pay a little bit more, but you get a lot more, I think it makes sense. I mean, even like staying in a hotel. If you're gonna go stay in a hotel, and one hotel is like $10 cheaper than the other, but the more expensive one also gives you free parking, free breakfast, and some other amenities. Ultimately, you're a lot better off paying the $10 more per night because you get a lot more in value for that money. So we are looking at value, not as an investment style, but what do you get for what you pay? And we are very low cost. We're not rock bottom cost. And I also don't encourage anybody to shop for the cheapest dentist in town or go to the cheapest sushi place. So be careful that the cheapest, it's the best value. That's what we aim to be. Now, why should you invest in dimensional funds? So if you look at dimensional, I think it's you would get this incredibly diversified exposure to, depending on how you invest in what fund, 10 to 12,000 different companies around the world. And the way you would get it is through this further exposure, this increased exposure, what's called tilts towards small companies and value stocks. And what's also interesting is that there are times, particularly when these technology stocks are running very hot, when this group of stock, for example, group of stocks like large growth, would actually do better than value. And we absolutely know that happens. And it's not a concern to us because if you look historically, what's so fascinating in terms of value beating growth, what you see is that on a 1 year basis, about 60% of the time, growth beats value. So it's not unusual. So I'm not at all I'm so proud of Dimensional and how it behaves and how it did, because we know that 4 and 10 years is not going to be there. Even if you give it 5 years, 70% of the time, the value outperforms. But 1 in 3 periods, 5 years, it's not going to be there. So I'm not at all concerned. I'm super excited because I think, if anything, I'd be more concerned about the valuation of growth stocks. And that to me is the key insight here. Value has not done badly at all. The anomaly here is not value. The anomaly is growth. And just to kind of wrap up, because it's such an important issue. If you look at the valuation, you talk about valuations for value stocks, it's been incredibly consistent through time, including now. It's exactly where it's been historically. So value has performed in line with the long-term average. The anomaly has been growth. If you look at the valuations of growth stocks, boy, they're shooting up even more than they did in the 90s before we had the technology bust. And that's where you have to be cautious. Like, to me, what are you more afraid of? An investment that is in line with a long-term valuation, or one that is way out of whack? And I have no idea how long this is going to last, but in terms of how I think about investing, I'd be a lot more concerned about something that has run up in price like crazy, and it's way outside the norms in terms of valuations for the US market, at least.
Great. You addressed 2 further questions, which is the second question, I think most upvoted question, that is, how does tilting away from growth stocks towards value stocks make rising valuations less concerning? 2 points. Diversification and less downside risk from overexposing to growth stocks.
Correct.
And is it correct to assume that Dimensional constructs their portfolio based on market cap weights, but tilts these weights based on small cap and value cap?
Wow, that person said it better than I could. I mean, it's exactly that. When you buy into the strategy, the idea, the concept, you are diversified across the entire market. You're not missing out on large. You're not missing out on growth and capitalization. What I just showed you earlier with the market capitalization at the S&P, we absolutely consider that. But then what we do, think of this, young. If you have an ice cube tray that is level, and this is the market, every cube would have the right amount of water. What we're doing, we're taking away and tilting this and taking a little bit of water from large and growth, but you still have large growth. And then we put it towards small value, but we're not doing this. We're not just taking away all the money from large growth. So you will have large companies, you will have growth. It's just a little bit less than you would have in a market portfolio.
Exactly. We have a very geeky audience.
I love that.
Are factors considered risk premia or simply stock characteristics?
So that's the very insightful question once again. The difference between a stock premium or characteristic, they're related. A stock characteristic gives you information about the potential returns that you would get into a stock. And the reason we call it a risk premium, the way that the participant called it, is because the reason that small outperforms large, the reason that value beats growth, is not because the market somehow mispriced it, but there is a risk story. And that's exactly what we think this, if you want to call it like the way that the audience member called it, a risk premium, in the sense that you get paid a little bit more for taking additional risk. And I think it's interesting because I'm not sure that I know this very well, but in the US, there's a company that's called Fair Isaac Company, which produces something called the FICO score. And the FICO score is a number that everybody in society has that reflects the credit worthiness. And it goes from like 500-600 to 850 being the top. And when you apply for a credit card, when you apply for a loan, the interest rate that you pay on that credit card and that loan is based on your credit score. And if you have a high credit score, your interest rate is lower. And I think that if you look at the stock market, it applies that concept to value and growth stocks. So the same dollar of earnings, it's probably valued less in some companies because there's more uncertainty. Their FICO score, if you want to call it that way, is lower. I'm not sure there's something similar in Singapore, Hong Kong.
I'm sure there is. Yeah. Another question, interesting question on sustainability.
Yes.
You have sustainability versions of your fund, and we have that on the platform as well. Does those versions of your fund outperform?
The simple reason they were not built to outperform. They were not built to underperform. They were built to provide exactly the same expected return as a non-environment, non-sustainability fund for the same level of tilt towards small and value. And the only reason that we created those is not because we think sustainability is better or worse, but rather in the US and around the world, there is a preference that people have. I want to align my values with the way that I invest my money. And if I can do that without missing out on diversification, returns, without costing me more, why not do that? And for some people, it's really important. For others, not. I mean, we don't have vice funds, but in terms of sustainability, I think it's absolutely a preference that aligns values with investments. It's not designed to underperform and outperform. And there are years when energy stocks do well, and in those years, perhaps a regular fund would do better. There are other years like 2020. Remember the pandemic with the negative price for oil, when energy stocks do really poorly and the sustainability is better, but it's a wash. Over the long run, you find that the expected return is driven by exposure to small value and then profitability, which is called quality, which is something called quality. And those are the main determinants of the expected performance, not the fact that it's sustainable.
Yeah. Great. We have a few questions lined up, so I'll let you take a break.
No, I love it. I love it. It's like
yeah, I know you love it, and I really appreciate it. Thanks so much. We have more. Actually, yeah. Are you okay to run over a little bit?
Still in my dad.
Okay. Yeah. Let me address a few questions lined up. So the first question is pretty detailed as well, and I can tell that whoever asked this question has looked into our portfolio. Why does the Endowus flagship portfolio, 100% equities allocation, have a tilt towards value stocks? emerging markets and 50.5% allocation to dimensional funds.
Yeah.
Okay. I'll start with the overarching philosophy of our flagship portfolio.
Yep.
Yeah. So I'll try to keep it short. But I guess the framework that we take when constructing our portfolio is we want to provide investors with globally diversified exposure. And Dimension is a great fund manager, but we also want to have manager diversification. So I don't think it will ever happen if Dimension ever goes out of the business, right? We still have allocation to other managers. And why 50% to dimensional funds? It offers a really diversified exposure to investors, to retail investors. For example, in its global equities fund, it has a few thousand stocks, a lot more diversified than your usual index fund. And we also adopt an evidence-based approach. So there is this whole spectrum of market efficiency. And in more efficient markets, it makes sense to use passive funds, to use systematic funds that with a tilt factor to improve the chance of outperformance. Whereas in other markets, like emerging markets, it probably makes sense to have allocation to an active manager that has proven track record of delivering outperformance, delivering alpha from idiosyncratic risk through stock picking, for example. And this overarching belief has led to us having a slight tilt towards value stocks because, historically, academically, it has been proven that value stocks in the long term outperform growth stocks. I know the past few years have been ups and downs for, value investing, but these are really too short to disprove the long-term historical evidence. I hope that addresses your question. If you have any follow-up questions, you can always email our cx@endowus.com to have more details. I also saw a question on CPF. So CPF, if you are not aware, is the pension scheme in Singapore, and it's huge. So historically, CPF has been consisting of really active funds, concentrated active managers, high cost. And we have been working with different providers to provide low-cost index fund solutions. And I'm very happy to tell that Dimensional is already retail registered for CPF scheme as well. So we are waiting for the official launch date, and we will keep you posted on that. It's been years of working on it, and so now it's the time, and we are very accelerated. All right. I have a very interesting question. Let me take a look. I saw it somewhere. Okay, maybe just one last question for you.
Anytime,
Yeah. On DCA, I'm doing DCA with money on my side, waiting for a pullback of the S&P. Should I just increase my DCA amount or wait for S&P to pull back 5 to 10%?
Got it. I think that, so for folks who might not be familiar with the acronym, DCA is dollar cost averaging.
Yeah.
And the idea is that do I want to wait for the market to pull down, and do I put all the money to work at once? And I think there's a human behavior element that if you can sleep at night, if you parse out the money over the next 6 months, that's great. And if that's what helps you get over the hump and not have a regret if the market goes up or down, that's one way to do it. I look at it more as statistics. I think that investing in life in general is not about certainty or guarantees. It's all about odds. Sure. I mean, I've started working out and eating healthier, but that doesn't guarantee me a longer lasting healthy life. It's all about odds. So you have plenty of buses around. But when you look at the odds, I think that the idea is that you are better off putting the money at work at once. And why is that? I'm going to give you like just a handful of, I think, some interesting statistics of why I believe that. And by the way, it was at a retirement community, and they wanted to talk about exactly that's DCA and then
Okay.
how to think about the odds of investing.
Yeah.
So it's in Northern California, and what they did is they had this rule where they watched the market every day, and then they just went and played tennis. It was a retirement community lifestyle. So what was interesting when I was thinking about odds is that when you look at the U.S. stock market, the S&P 500 over the past few years or the past 50 years on a daily basis, what's so interesting is that on a daily basis, roughly about 53% of all days in the market have been positive. You made money. You know, it's a positive outcome for investors, which means that 47% of the trading days were negative. You lost money roughly half the days. If you're investing or not investing in the market any one day, it's pretty much a flip of a coin. And in that respect, I can't tell you that DCA is going to be like make or break on a daily basis. But what's also interesting is that if you now repeat the same exercise and instead of asking, you know, what's the outcome for an investor on a daily basis, and now you just simply say, well, I'll be patient and wait for the quarterly statement, and now you look on a quarterly basis, what you see is that about 71% of the quarters in the market have been positive and 29% negative. So in that respect, if you wait and you're not in the market for a quarter, well, what's interesting is that you're a lot more likely to miss a positive one than a negative. You could miss a negative one and pat yourself on the back and say, great, I saved. The reality is that it's so random what happens from quarter to quarter. And if you're willing to wait for a whole year, well, it turns out that about 78% of the years for the past half a century have been positive and 22% negative. So the longer you sit out of the market, the worse your odds become. And I got to tell you, the last thing I'll know is that I wanted to tie this into something that they do a lot there, which is tennis. And I thought, okay, these are statistics, and these folks might not really kind of get so much into it. But what if I look at a tennis player that everybody knows? And I picked this gentleman. Do you know who he is?
Djokovic?
No.
Oh, yeah.
You said Djokovic.
I know his name.
You spend too much time investing.
Or something.
His name is Roger Federer.
So sorry.
No. It kind of shows that he's trying to time. But here's the thing. I'm not a tennis buff, so you know I happen to know because some of the friends from Basel where I live, they tell me that
I read a book on him.
Yeah. Anyways, but the thing is that I was curious to see how do you become the world's greatest male tennis player? Arguably, you can say Djokovic or somebody else, but let's say he's arguably one of the best tennis players of all times. How do you get to become that from a statistics perspective? If you look at numbers, and if you look at the way tennis is scored, you start by points. So when you look at the points that Roger Federer played in his career, it turns out that the greatest male player, arguably of all times, won roughly 54% of the points that he played. In other words, the greatest male player lost roughly half the points that he played, which is stunning. But what Roger did, he played all the points and he won the big ones. And if you give Roger some time, and instead of asking what percentage of the points did he win, you look at what percentage of the sets did he win, well, that percentage goes up and you're a lot more likely to see him winning a set than a point. And if you wait to see what percentage of the matches, the games that he won, that number goes up to about 81%. So what I think is so interesting is that the way that he become a tennis champion or a successful investor is not by, I want to win every point. Yeah, we want to win every point, but even the greatest tennis player loses roughly half the points. And how close are these statistics to the market? When the market drops any one day, don't be panicked any more than, oh, Roger lost a point. Let's pack our bags and go home. It happens. He loses roughly half the points. But if you give Roger time, or if you give the market time, it tends to provide better and better odds of you seeing a positive outcome. So when you come to DCA, again, there's a behavioral element, which is saying that, hey, if it takes you 6 months or 3 months, so be it. If you look at it from a statistical perspective, you're a lot more likely to miss a positive quarter or positive year than you are to see a negative.
Of course, So to summarize, timing the market increases your odds of successful investing than timing the market.
Not timing the market.
Then rather than timing the market.
Exactly.
Yes.
Stay disciplined.
Stay disciplined.
Stay disciplined.
That's right. That's a great takeaway. And thank you all for joining us until 10 minutes after the official time. I had a great conversation with Apollo, and I hope you enjoyed it as well. I hope that you have taken away something with you. So yeah, I just wanted to do the final reflection, and we can you can go and have your local food. Sorry.
Local food, yes.
I just wanted to say, because you mentioned that dimensional is only available is still only available mostly for institutions and ultra high net worth with financial advisors, personal financial advisors. But we have made great stride in improving the accessibility of dimensional funds as well as many other fund managers in Singapore and Hong Kong. So 6 years ago, dimensional was not available here to retail investors, but in 2019, it got approved for retail investors. And we were one of the first financial advisors that partnered with dimensional to make it available for all the Singaporeans, those who are living and growing here. And now we are very happy that it's available for cash and SRS and going to be available for CPF. And for Hong Kong investors, good news, for the first time in Hong Kong, funds managed by Dimensional will be part of Endowus individual portfolios. So the Endowus flagship portfolio will be available or might already be available from this month onwards. And Dimensional is a key part of that portfolio. Please check it out. And on the screen, I want to flash a session that you can schedule with our client advisors. So if you are interested or want to know more about Endowus, you can schedule a 15-minute session it's called Experience Endowus. We can go through the platform with our client advisors and ask questions. That's it. Thank you so much. Thank you, Apollo, and thank you, everyone. Yeah.
It's been great fun. Thank you so much for inviting us, and I really appreciate it. I love the conversation. It was great fun for me. Thank you.